Let me start with a scenario you might be familiar with. You've just made your first stock market investment. The excitement of owning a piece of a company is thrilling. You feel like you're on top of the world, ready to ride the waves of the stock market. But then, a few weeks later, the market takes a dip. Your stock's value plummets, and suddenly you're left wondering if it was all a big mistake. It's a familiar feeling. Many new investors have been there. In fact, as Paul explains in his book, How to Avoid Loss and Earn Consistently in the Stock Market, the path to consistent gains isn't just about picking the right stocks, it's about understanding the market's ups and downs and managing them wisely. Paul lays out a clear, simple roadmap for how to approach the market, not with the mindset of hitting it big overnight, but with the understanding that steady, calculated decisions lead to long-term success. Let's start with the basics. What is the stock market? To put it simply, it's a place where buyers and sellers trade pieces of companies, known as stocks. When you buy stock in a company, you're buying a small ownership stake in that company. Paul emphasizes that you're not just investing in numbers, you're investing in a business and its potential to grow. But here's the catch. The stock market isn't always predictable. Prices can go up and down based on a range of factors. One day your stock might be soaring, and the next it might be crashing. This fluctuation is completely normal, but it's also the reason why so many people lose money in the stock market. So how do you protect yourself from these unpredictable swings? As Paul says, the key is not to panic. Don't let your emotions drive your decisions. Investing is a marathon, not a sprint. Many new investors, especially those who are just starting out, get tempted by short-term gains, often making the mistake of selling when the market drops or jumping on the latest hot stock without doing enough research. But Paul stresses that this kind of impulsive decision-making is one of the main reasons people lose money in the market. As Paul says, market volatility is not your enemy, it's your friend if you know how to use it. That might sound a bit counterintuitive at first, but what he's really saying is that if you understand how the market works, you can use its ups and downs to your advantage. Instead of panicking during a market drop, seasoned investors see it as an opportunity to buy stocks at lower prices. The importance of risk management. Now let's talk about something even more crucial: risk management. Paul believes that understanding how much risk you're willing to take is a cornerstone of successful investing. When you make an investment, you need to consider not only the potential rewards, but also the potential risks. Imagine you've invested in a stock that's been doing well and your portfolio is growing. But then you read about a potential crisis in that company or sector. You don't want to lose all your gains, so what do? Many investors hold on, hoping that things will get better, but by the time they realize it's time to sell, they've already lost a lot. Paul suggests a far smarter approach. Always have a stop-loss strategy. This is a plan where you decide in advance at what price point you'll sell a stock to avoid further losses. By setting these boundaries ahead of time, you're able to control your emotions and protect yourself from unexpected downturns. Paul says risk is part of the game, but the key to avoiding loss is understanding how much risk is acceptable to you and how you can manage it. Managing risk isn't about avoiding it altogether. It's about minimizing it and making sure it stays within a level you're comfortable with. Once you accept this, you'll start to approach the market with a much clearer, more level-headed mindset. The mindset of a successful investor. But even with all this knowledge, there's one thing that Paul emphasizes as crucial to long-term success: your mindset. It's easy to get caught up in the thrill of buying and selling, but the best investors don't think in terms of quick wins. Instead, they think in terms of strategy, patience, and consistency. As Paul puts it, success in the stock market isn't about finding the next big thing. It's about making informed, calculated decisions over the long term. So let's break this down. What does this mean for you, the investor? First, you need to learn to be patient. The stock market can be slow at times and it's easy to get frustrated. But Paul reminds us that steady growth is often the most reliable. Second, you need to educate yourself. The more you understand how the market works, the better equipped you'll be to make smart decisions. And finally, always be ready to adapt. The market changes and so should your strategies. Now let's understand Paul's strategies to earn consistently and avoid loss. You've understood that the market is unpredictable, that risk management is key, and that patience and mindset matter. Now the big question is, how do you actually earn consistently? Paul says that consistency in the stock market isn't about luck. It's about applying proven strategies, sticking to rules, and making decisions that protect you from big losses while allowing your profits to grow steadily. Strategy 1. Always know what you own. A mistake many investors make is buying stocks without truly understanding the company. Paul stresses that you must know not just the stock price, but the company behind it. Ask yourself questions like, what does this company do? How does it make money? Is its business growing or struggling? When you understand the business, sudden market swings become less frightening. You know whether a dip is temporary or a real warning sign. Paul emphasizes that buying blindly based on tips or market hype is a fast track to loss. Strategy 2. Entry and exit points. Here's something crucial that Paul highlights. Where you enter and exit a stock can make all the difference. He explains that even a good company can lead to losses if you buy at a peak and sell at a trough. A practical approach is to set target prices before buying. Decide in advance at what price you will take profits and at what price you will cut losses. This removes emotion from your decisions. As Paul says, don't let greed or fear decide your trades. Decide before you act. This is where technical tools like support and resistance levels can help. You don't need to become a full-time chart expert, but learning simple indicators helps you know when a stock is likely to move up or down. Strategy 3. Diversification. Don't put all eggs in one basket. Paul warns against concentrating all your money in one stock or sector. The market is unpredictable, and even a strong company can face sudden challenges. By diversifying, spreading your investments across sectors or different types of assets, you reduce the risk of a single loss wiping out your portfolio. It's not about limiting your gains, but about protecting yourself from sudden shocks. For example, if you invest in a mix of IT, FMCG, and pharmaceutical stocks, a fall in one sector is less likely to devastate your portfolio. Paul compares this to safety nets. Diversification is your insurance against the unknown. Strategy 4. Avoid overtrading. Another common mistake is overtrading, buying and selling too often. Many beginners feel the urge to act on every market move, thinking they can catch every opportunity. Paul strongly advises against this. Overtrading increases costs and often leads to emotional decisions rather than rational ones. The more you trade without a clear plan, the higher the risk of losses. Instead, focus on high-probability setups and stick to them. Think of investing like farming. You plant seeds, water them, and wait patiently for the harvest. Constantly digging them up to check growth doesn't help. They still need time to mature. Strategy 5. Learning from losses. Even with the best strategies, losses happen. Paul says the key is to treat every loss as a learning opportunity. Instead of panicking or blaming the market, ask yourself, what went wrong? Was it a mistake in research or timing? How can I prevent this in the future? By keeping a simple trading diary, you can track patterns and improve over time. Paul emphasizes that successful investors are those who analyze mistakes objectively and adjust their approach. Strategy 6. Avoid herd mentality. The market is full of opinions, tips, and rumors. Many investors lose money following the crowd, buying stocks just because everyone else is. Paul stresses independent thinking. Your decisions should be based on analysis and your strategy, not what friends or social media suggest. Herd mentality leads to buying high and selling low, the exact opposite of what you want. Practical approach to consistent earnings. To summarize Paul's advice for earning consistently. 1. Know the companies you invest in. 2. Set clear entry and exit points. 3. Diversify to reduce risk. 4. Avoid overtrading. 5. Learn from every loss. 6. Ignore the herd and stick to your plan. When you combine these strategies with patience, discipline, and a clear mindset, the stock market becomes much less intimidating. Instead of gambling, you're investing with purpose and direction. In practical terms, think of your portfolio like a business. You manage risks, monitor performance, make informed decisions, and reinvest profits smartly. Paul points out that consistent earnings don't require extraordinary luck. They require smart, repeatable steps applied over time. We've covered the basics and the key strategies to avoid losses and earn consistently. Now let's move a step further. Paul emphasizes that to truly succeed in the stock market, you need to combine knowledge, strategy, and mindset into a disciplined, long-term approach. Let's start with a scenario many investors face. You spot a company that everyone seems to be talking about. Its stock is rising fast, and the temptation to jump in is strong. But instead of rushing, you pause. You check the company's fundamentals, its recent financial performance, and the market conditions. After analyzing, you realize the stock is overvalued. You resist the hype and wait. Weeks later, the stock corrects sharply. Because you stayed disciplined, you avoid a significant loss. This is the kind of practical, disciplined approach that Paul advocates. Success in the stock market isn't about chasing every opportunity. It's about patience, analysis, and controlling your emotions. Advanced Principle 1. Understanding market cycles. Paul highlights the importance of recognizing market cycles. Markets move in phases, bullish periods when prices rise and bearish periods when prices fall. By understanding these cycles, you can align your investments with the right opportunities. For instance, during a downturn, many quality stocks become available at lower prices. Instead of fearing the drop, you can see it as a chance to buy at a discount. On the other hand, during a strong bull market, you may want to take partial profits to protect gains. The key, as Paul explains, is to observe trends without letting emotions dictate your moves. Market cycles are natural, and learning to ride them intelligently is what separates consistent investors from those who panic. Advanced Principle 2. Focusing on quality over quantity. Another crucial point Paul stresses is quality over quantity. Many investors spread themselves too thin, investing in too many stocks, sectors, or markets. Instead, focus on a smaller number of high-quality investments. These are companies with strong fundamentals, proven business models, and a track record of growth. By concentrating your attention on a few solid investments, you can monitor them closely, understand their behavior, and make smarter decisions. As Paul says, it's better to have a few well-researched investments than many that you barely understand. Advanced Principle 3, developing a long-term mindset. Consistency in the stock market comes from thinking long-term. Paul encourages investors to avoid short-term thinking. Prices may fluctuate daily, but a long-term perspective allows you to benefit from the underlying growth of businesses. For example, investing in a company with strong fundamentals may result in short-term dips, but over months and years, the stock can grow significantly. By keeping your focus on the bigger picture, you reduce stress and make decisions based on analysis rather than fear or excitement. Advanced Principle 4, using tools and resources wisely. Paul also talks about leveraging tools to stay informed and make smarter decisions. These include financial statements and annual reports, understand revenue, profit margins, and debt. Stock screeners, identify companies that meet your criteria for growth, value, and risk. Market news and updates, stay informed about macroeconomic trends without overreacting to daily noise. But the key, Paul warns, is to avoid information overload. Too much data can confuse you and lead to indecision. Use tools selectively to support your strategy, not to overwhelm it. Advanced Principle 5, the psychology of successful investing. Perhaps the most important insight Paul shares is about psychology. Emotional control is critical. Greed and fear are the biggest enemies of consistent profits. When the market is rising, greed can tempt you to overinvest or chase returns. When the market falls, fear can push you to sell prematurely. By cultivating discipline and emotional awareness, you can make rational decisions and stick to your plan. Paul encourages keeping a simple journal. Note why you bought a stock, your expected outcome, and your exit strategy. This habit builds awareness, reduces emotional reactions, and improves your decision-making over time. Here's a practical summary of Prasenjit Paul's step-by-step approach. 1. Start with research. Know the company and the market environment. 2. Plan your trade. Decide entry and exit points before investing. 3. Manage risk. Use stop-loss orders and diversify your portfolio. 4. Stay disciplined. Avoid overtrading and herd mentality. 5. Think long-term. Focus on consistent growth, not quick wins. 6. Learn and adapt. Treat losses as lessons and adjust strategies. 7. Monitor psychology. Keep emotions in check to make rational decisions. Paul reminds us that the stock market rewards preparation, patience, and discipline. By following the principles in this book, you can protect your investments, reduce losses, and steadily grow your wealth. Now it's your turn. Take these insights, apply them to your investments, and start building a smarter, more consistent approach to the market. If you found this audiobook summary helpful, don't forget to comment below, share your thoughts, and subscribe for more actionable insights. Your engagement helps us create better content and keeps you on the path to smarter investing.